Hi everybody, welcome back to our discussion of Chapter 9. In our prior video lecture, we discussed the application of the lower of cost or net realizable value method to measure inventory at the end of an accounting period. In this video, we'll discuss the lower of cost or market method. Companies that use LIFO or the retail inventory method to report inventory must use the lower of cost or market approach. You might interpret the term market to mean the amount that could be realized if the inventory were sold, but that would be similar to the concept of net realizable value discussed in the prior video. Therefore, market is defined differently. Market is the inventory's current replacement cost, except that market should not be greater than the net realizable value, which forms a ceiling on the market, and market should not be less than the net realizable value, reduced by an allowance for an approximately normal profit margin. This forms the floor on the market. In effect, we have a ceiling and a floor, between which market is decided. If replacement cost is between the ceiling and the floor, it represents market. If the replacement cost is above the ceiling or the floor, then the ceiling or the floor becomes the market. The designated market amount is compared with cost, and the lower of the two amounts is used to value inventory. I know this sounds confusing, so let's walk through an example one step at a time. First, we need to calculate the ceiling and the floor for each item of inventory. Here is an example. The Collins Company has 5 items of inventory on hand at the end of the year. The year-end selling prices and the estimated costs of completion, disposal, and transportation, referred to as selling costs here, for each item are given below. In this example, the normal gross profit ratio for each product is 20% of its selling price. These amounts are used to calculate the ceiling and the floor as follows. In item A, the selling price minus the estimated selling cost equals the net realizable value, or ceiling. The floor is calculated by subtracting the normal profit margin of $20,000 in item A from the ceiling to calculate the $65,000 floor. And this is done to calculate the ceiling and the floor for each item. Next, we're going to calculate the market. Notice that for each inventory item, the market is simply the middle value between replacement cost, ceiling, and floor. We do need some additional items of information. So additional information related to the year-end inventory, determined by applying LIFO cost method, and the replacement costs are given in the first 2 columns. Determination of the lower of cost or market is a 2-step process. First, calculate the market using the replacement cost, subject to the ceiling or floor, and second, select the lower of the cost or market. When replacement cost is below the floor, such as in item A, then we will select the floor as the market. When replacement cost is above the ceiling, such as items B and D, then we select the ceiling as the market. When replacement cost is between the ceiling and the floor, such as in items C and E, we then use the replacement cost as market. Then we compare each item's designated market amount to its cost and choose the lower of the two. After doing this, ending inventory under lower of cost or market for all the items is $387,000 in this example. This means that the recorded cost of $415,000 needs to be reduced by $28,000. That's the $415,000 inventory at cost under LIFO minus the lower of cost or market of $387,000. We record that adjustment to cost of goods sold if the decrease to market is considered normal for this company. Debit cost of goods sold, credit inventory, $28,000 in this example. In situations where a write-down is substantial and unusual, the write-down should be recorded in a loss on inventory write-down account. The example we just saw calculates lower of cost or market on an individual item's basis. In this slide, cost and market are brought forward from the slide number 9-12. For instance, item A, the cost was $50,000 and the market was $65,000. Which is represented in cost and market columns. We can also apply the lower of cost or market method to major categories of inventory or to the entire inventory, just like we saw under the lower of cost or net realizable value approach. Inventory using the lower of cost or market approach applied by categories would be $397,000. If we calculate lower of cost or market by total inventory, the amount for the ending inventory would be $402,000. Here's another concept check problem for you. The following information pertains to one item of inventory of Forge Company. The per unit cost is $270. The replacement cost is $225. The selling price is $292. Normal cost to sell are $52, and the normal profit margin is $31. Please pause your video to calculate the lower of cost or market for this unit of inventory. Then start your video again to check your answer. The correct answer is A. The replacement cost of $225 is between the $240 ceiling, which is the $292 selling price minus cost to sell of $52, and the floor, which takes the $240 ceiling and subtracts the normal profit margin of $31. Then market of $225 is compared to the cost of $270, and we select the lower of the two amounts, $225. Well, that's all for this video. In our next video, we'll begin our discussion of inventory estimation techniques.